Hello Finedits. Let's analyze how the shares are traded into the market. My name is Harshit and you are watching the Matrix Decoded. Stay tuned. Now, if we take an example into this, let's say there is a buyer, Mr. Tenari Bond, hope you remember him. If he is willing to buy a particular security at a price at around 965.25 and he is buying at around 10 in the morning, selling it by the end of the day at 3 p.m. at around 998. So the total margin always will be ask price minus the bid price, for which we calculate the particular thing called spread. Now, how much the spread is coming up to? 998 minus 965.25. So it is coming at around 32.75. Now, for an example, let's say he is purchasing 10 units, 10 shares of this particular security. So the total profit will be 32.75 into 10, which means 327. Finalists, you must have always followed a traditional approach of going forward with the stocks, that is buying at low and selling it at a higher price. Now, let's understand a new concept, a totally different concept of approaching towards the stock, and this is called short selling. Now, what do you mean by short selling? What is it? How does it help the investor? We'll understand all of these. Now, short selling is a feature in financial market where you sell a particular security even without buying them at the first place. Isn't it wonderful? But in India, it is only allowed for intraday, that is T+1. The settlements are being done. In 2007 and 2008, followed by the GFC crisis, global financial crisis, the short selling was not just restricted but also banned in many countries. Recently, there was a country, Indonesia, which again reopened the short selling after banning it 3 years back. Now, short selling is an investment technique that tends to draw profits from the declining prices of the security value. So as the value of the particular security declines, so will the profit will be increasing for the short sellers. Why? Because they are speculating a dip in the current price of which the stock they are getting into short selling. Now, many investors and economists believe that short selling sends important signals to the market. Why did you feel so? It is because short selling makes the price discovery very acceptable and also corrects the company according to the fundamentals of the company, which in turn is very, very essential. Let's say there is a bubble that is being created for a particular company, and now the bubble is getting burst by the short selling or the selling pressure that is being caused due to the lack of fundamentals associated with the company. So there's another side of short selling that we discovered right now. My main agenda is to make you aware of both the sides, the pros as well as the cons of short selling. Now, we will understand one more concept, something that is very much uncommon into Indian practitioners, but I believe you must know it. So, Finalists, now we will be discussing about something more than short selling called SLBs. Security lending and borrowing is an investment technique through which investors, similarly like short sellings, make their profits by the dipping price of the securities. SLB refers to stock lending and borrowing mechanism through which an investor borrows the stock from another investor, as well as there will be another investor who will be willing to lend or rent it to that investor for a fixed set of interest as well as the amount. SLB gives an investor chance to rent their investment holding, which is a part of their portfolio, for an incremental set of dividends, or let's say the incremental set of returns that they can get from holding these shares. So SLBs are similar to FNOs, where they are settled weekly, monthly in most of the cases, and in some kind of exceptional cases, it can go beyond a month as well. So now let's understand this with the help of an example. Let's say there is an investor, Mr. Tenali Bond, who holds 100 shares of this particular security called Reliance and is willing to rent these shares. Now there's another investor, Mr. Harshit. Now he is willing to purchase or borrow these securities from the investor, Mr. Tenali Bond. So what Tenali Bond will do? He will have 100 shares of Reliance, which is trading at rupees 2. He will calculate the annualized return that he is getting out of it, which is 24%. So that makes rupees 24 out of his investment for a particular year. So now, since Mr. Tenali Bond has calculated all the returns that he will be foreseeing for the particular security of Reliance, he will lend these shares to Mr. Harshit, who is willing to borrow it for a particular tenure. Now, both the parties will come into contract with a middleman, and here it is NSE, which takes care of the clearinghouse, settlements, and all the formalities and nitty-gritties which needs to be formalized before the both parties enter into a trade agreement. FIIs, or the foreign institutional investors, have a deep interest into short selling. Now, what they will do? They have to get themselves registered with a regulatory authority of the particular country. Let's say there's an investor sitting in US. He will come in touch with the regulatory authority of India, which is SEBI, as we discussed in the previous lectures, and indulge into short selling, or SLB in this case, which is not just for intraday, but also they are getting a momentum for a continued period of time, which in turn will also increase their profit if the research done for the price for the particular security is accurate. Finally, now we will reach the conclusion of this particular video. In this video, we learned how short selling is important in pros and in the cons manner as well. We can also say that on one hand, it helps for the price discovery, correction with respect to the fundamentals of the company, which is very important. It is also beneficial to the hedge fund analysts, which in turn do massive buying and short selling into different securities to attain profit for the investors. But on the other side, the market cap of the company is dropped heavily, which in turn decreases the overall performance of the particular security. In short selling, the prices are dropped of the securities, but it also affects the whole economy and the stock in other ways as well. Not just the investors loses their trust into the particular company, but they will also hesitate into entering the market as well if they have heavily relied on the particular stock. Now, let's say we are talking about a particular stock called Reliance, and if we are going towards short selling into this particular security, of course the market cap will drop. Now, the promoter of the particular security, Mr. Ambani's, even if they are quite rich, they will not increase the market cap of the particular security. Why? Because let's say the promoter, Mr. Ambani, tries to buy the particular stock for the company, it will go into the promoter's holding, and promoter's holding does not reflect into the number of outstanding shares held by the public for deciding the market cap. So even if the promoter tries to pull a string, he will fail to do so with respect to the market cap. Now I guess you have fully understood the concept of short selling, SLBs, what if the promoter tries to buy the particular security from dipping down. All these concepts have been clearly understood by you. Pin your comments if you want me to explain something different. I will be happy to help you out. I'll see you again.